The hell was that yesterday? What was that about? 30,000. Now we're going 31,000 a day later. Wow. I mean, the rules are just out the window. I mean, it's pointless to even say, here's what should happen, because this is ridiculous. Here's oil coming up to 51 on a bad report. If we look at the petroleum status report, and here's the 1 o'clock version. Hopefully it's the right one. The weekend of January 1st. Perfect. Okay. So, so crude imports average 5.4, which is unbelievably low. All right, inventories rose. There was a decrease of oil by 8 million, but and inventories are still 9% above their 5-year average. Gasoline inventories, though, decreased by 4.5 million. No, I'm sorry, increased, not decreased. The increase by 4.5 million, and they're the 5-year average for this time of year. Finished gasoline decreased. All right, distillates increased by 6.4 million barrels. Increased by 6.4 million barrels. So we had a 11 million barrel increase in distillates and gasoline, and an 8 million barrel draw in crude is a net 3 million barrel build. So that's ridiculous. That's not a good report. That's nothing to be positive about. That's incredibly bad. If they make more oil, the refineries, for the holiday traffic, then there's no holiday traffic, so the oil sits unused in the inventories, or the gasoline sits unused in the inventories. And overall, you can see we went from 1980 to 1981.8. So there's not a draw, it's a build. I guess all other oils had a draw of some kind. Yeah, all other oils had a small draw. But this is not a net positive report. 4 weeks ago, we produced 19 billion barrels a day. Now this week, we produced 18.7 billion barrels a day. So we're producing less, and still there's a build. These aren't good things. I don't know what the hell people are talking about. Yet price-wise, look at this insane stuff. Price-wise, you're paying basically the same. You were paying $250 last year. You're paying $225 this year, 10% less. That's all we're off on this incredibly low production. Also, check this out. Petroleum products, we exported 3.3 million barrels a day. And if we get a handy-dandy calculator out, so 3.36 times 7, 23 million barrels of oil, of petroleum products, not oil, because it's petroleum products, of refined products were exported out of the U.S. So of this refinery turnover here, out of 18.6 million we make per day, 23 million were exported for the week. That's more than 1 day's worth has been exported, and still we have no demand. Still we end up with a build in this country. That is crazy. So, and you can see the numbers in the reports we got today, in the ISM and the PMI and all this other crap that we got. Need some notes somewhere. I was talking about this stuff. Factory orders. Factory orders were 1.3 last month. They're 1%. They're still going, up a little bit, but still not very exciting. Unfilled orders down 0.1%. So that means orders are slacking off. It means Christmas. Things are not supposed to be slacking off. Business activity growth, the slowest for 3 months. So the business activity is back down, dipping. PMI composite is 55.3 versus 55.7. It was expected to be 58. Oh, I'm sorry, consensus was 55. So it's a little bit below consensus, but a real dip from last month. And the services are down. The output and new orders growth is easing. This is not cost burdens rising. The survey, and so inflation is kicking up. Activity is slowing down. These are not good things. And I know that it sounds ridiculous to say how this doesn't sound good and that doesn't sound good. But meanwhile, the markets look fantastic. Look, it's great. I mean, a good part of this is Biden, obviously, the Democrats are now going to control the country. Sanity will begin to return slowly, but at least there'll be some chance that we can get back to normal as a country. We don't have to sit there and deal with Mitch McConnell for frickin' blocking every single thing that we try to do for the next 4 years, or 2 years at least, but I think 4 years. Yeah, I think Donald Trump has killed the Republican Party. That's what I believe, but we'll see what happens. But anyway, the bottom line is it looks like the Democrats are going to take control of the Senate. Not sure. It's technically not control, though, because it's going to be 50-50, Republican and Democrat, and because of that, Kamala, I don't even know how to say it. But anyway, the vice president casts a tie-breaking vote, and that gives the Democrats effective control, but it's really 50-50 in Congress. So the Democrats are going to have to 100% hold ranks, and then the vice president has to come in and agree with the vote and cast the deciding vote. So she'll be spending a lot of time in the Senate. But the question is, do you no longer have a Senate majority leader in that situation? Because what happens to McConnell? He's not the majority leader. He's still, do you have 2 majority leaders? I think that's an interesting way. You have no majority leaders. I don't know if it's good to be leaderless. Although I'd say better to be leaderless than to be led by McConnell. But that's going to be very strange. I'm not sure what happens there. Maybe Harris becomes a majority leader. I don't know what the hell. I really don't understand what the deal would be. So that remains to be seen. But still, the bottom line is, anything's better than what's been going on. The Russell is now up almost 5%. I said 3% was too much this morning, so now it's up 5%, 4.76%. That kind of move for a major index is ridiculous. The Dow is up 2%, and the S&P is up 1.5. The Nasdaq is still down a little bit. They were a bit disappointed. Look at gold, though. Gold totally crashed. So, I was going to say 5% were right. So gold is really great to play off this 1900 line, because the 1900 line was a 2.5% drop, and therefore you're going to get a bounce, right? That's the whole point of the 5% rule. So let's take a look at that. That's going to be educational. Why did I tell you? I feel much better having that vacation. I'm much more energized as far as this stuff goes, because just sitting there in the house for month after month after month, it just kind of gets to you. Well, now I have something in my throat, so I probably die of COVID because I went on vacation. No, I'm fine. It's just the way I was drinking my tea. But always scary, right? Every time you cough or sneeze, you're always like, am I going to die? And that's a horrible way to have to go through life. Anyway, what was I saying? Oh, yeah. So look, we peaked out here, and we were on downswing, so this is not a big deal. We come up from 17, whatever the hell it is, but let's, what's a good way to look at this? Well, I guess to start, you got to say what's the major support on gold. So the major support on gold is 24 and 16, and in between 24 and 16 is going to be 2000. So 2000 is your major line on gold. Okay, it's gold was 800 back in the day. It went to 12, it went to 16, it consolidates more at 16, and then it goes up to 20. Consolidated very little up at 20. It actually got rejected at 20, comes down, and now it's consolidating under 20. So it's probably going to keep going. And if Bitcoin is going to keep going, gold's going to keep going. Also, if you look at this trend, see this trend coming up? You've got the sink here, and you've got this thing, and this is going to cross over here, kind of like it did here, and that led to a pretty sustained uptrend. And it is lined up with this thing coming back over also. So we got probably a lot of strength. The volume has been pretty low over here compared to where it was. So if the volume comes back and the interest comes back in gold, we can expect some real big moves up. I don't like to play gold this high. But again, that's, we go back to Barrick Gold, which was our stock of the year, and stock of the year last year. See, and we smartly got out when it hit 30. We were done with it because we said that's a little bit more. We thought it was a good stock back in November at 16.50 actually. We thought it was going to be the stock of the year. We picked it. It was doing great. Then it crashed. Fortunately, we stuck with it and bought more. Then it went way back up. But when it got to here, that was just insane. It doubled from where we originally came in. So we were done. Now it's come back though. So now it's becoming interesting again. I don't think gold's going to get too much lower than it is right now. So that makes GOLD becomes a more interesting play. At 24, I wish it was lower, but I don't know that we're ever going to see lower. Sometimes they could have if something happens, that would be the best bet. If there's a strike, there's a mine closure, they get fined by somebody, they get cited for environmental bullshit. That's what you want to look for companies like that. Just like Boeing. When a plane crashes, buy Boeing. Planes crash. Unfortunately, that's what happened. Now, we weren't gung ho on Boeing this time around because there was a fundamental design flaw in their plane, and we weren't sure they were going to be able to fix that. And having to scrap the entire 737 production line. I don't know why I keep drinking this tea every time I drink it. I cough. It's roasted barley. That's the problem. Doesn't agree with me. That's more evidence that I have a weed allergy. Because I've been told I have a weed allergy. And there you go. Interesting. Anyway, so what was I going to say? So we're not going to get, if we think gold's going to hold up and it's not going to quite get back down, our goal was 1650. But just because it won't get back to 1650, we could sell $20 puts for $3, and then we're in for net 17, and we know we want to buy it for 17. Oh, I'm sorry, I was talking about Boeing. So Boeing, it's the same thing. Companies that are cyclical, whenever they have a trouble, especially if it's kind of trouble that they're going to get past. So the 737s, we weren't positive they would be able to fly those. And if they had to scrap the entire 737 production line, that could have been completely devastating for Boeing. They may have almost not been able to recover from something like that. So that was tough to call, although obviously we bought Boeing when it was super low. But once it got to the middle, it wasn't fun anymore. Barrick is a different story, because Barrick, we know at 1650, the price of Barrick becomes to such a point that it's ridiculous not to recognize that their gold reserves are worth more. And there you have to do the math and say, okay, they have X amount of gold. They have about 70 million ounces of gold in the ground. And therefore then the cost, then you have to calculate not the value of the gold, but the value of the gold versus their cost of extraction. And Barrick, the reason I always like Barrick, they have the lowest cost of extraction. They're very focused on that. They'll buy a portfolio of mines from a miner, they'll sell off all the mines that don't have a low cost of extraction, and they will then evaluate and see how low they can put the price, because they're very good at getting a lower extraction cost out of their mines. In fact, I have a friend investing in a gold mine right now, And the key reason they want to invest in the gold mine is because it's next to Barrick. Barrick has a mine in the Dominican Republic, and my friend has access to a piece of land on basically the other side of the same mountain from Barrick. Obviously, I believe from what I've looked at that Barrick has taken the better side of the mountain, but the bottom line is they only took one side of the mountain. It's the same deposits, it's the same mountain, and there's probably not as good a deposit on the other side, but there certainly are deposits, and I don't mind being the second best miner next to Barrick. So, you know, that's a big positive, is the fact that Barrick did set up an entire mining operation on the other side of the mountain. The government wouldn't give them, they wanted to buy the whole mountain, the government wouldn't give it to them. Barrick took the one side, which I guess they decided was the better side, but they wanted the whole thing. So they're very good at their job. That's the bottom line. So I always like to buy Barrick rather than, which is unfortunately called gold now, so it's hard to differentiate. But I would rather buy GOLD Barrick than buy gold itself, because gold hasn't got any real value, just like a Bitcoin hasn't got any real value. But it is something you can put a floor under, because there's a certain cost of extraction, and you know people want gold. It's very unlikely people stop wanting gold at any point ever, you know, completely stop wanting gold, because there's a certain price at which it starts having industrial value. Like gold is used in phones. Gold is used in a lot of electronic stuff. It's the best conductor in the world, and it's very expensive conductor, but it's the best conductor, so they do use it on things. And so there's always demand for gold on the industrial scale. That helps drive it. That's why silver also has always a base industrial demand. So, you know, there's a minimum value to Barrick's gold, and let's say that it's very, very, very unlikely that gold's going to go below $1,000 an ounce. And frankly, most miners have $1,000 per ounce cost of extraction. Barrick's cost of extraction is more like $800. So even in a complete collapse of the gold market, Barrick is still able to pull gold out of the ground and make a $200 profit on their gold. So if they're making a $200 profit on their gold, and they're pulling out, let's say, 5 million ounces a year, 4 million, let's say conservatively 4 million ounces a year if it's a bad year, they're still going to make $200 times what did I just say? Times $200 times 4 million is what? Is $1 billion, right? Is $800 million. Yes, correct. 800. Yes, 4 million ounces, $200, $800 million. So now we look and take a look at Barrick and make sure that we're not crazy. So we go over to Barrick. And, you know, this is how you evaluate a company. You've got to have a premise, and you've got to think about what's going to make them money, what's going to make them not make money, what's their long-term perspective, so on and so forth. So let me go to gold. And oddly, we were looking at Corlick, the other gold company last time, gold. You know, and as you can see, they're capable of losing money, but as you can see, 650, 1.4 billion, minus 1.5, 4 billion, 3 billion, projecting 2 billion, 2 billion, but these gold prices are going to be above that on their projections, because that's the net cost of extraction versus what comes out of the ground. So they're making double what we think is the minimum right now in selling their gold. And making $2 billion, and you can buy the whole company right now for $43 billion. So they're trading at 20 times earnings. All right, if they're doing $4 billion like they did last year, and I you know, honestly don't know why they went down so much this year. But if they're doing $4 billion like they did last year, this becomes a real bargain. But that's not being projected. Last year was a really good year. Who knows? They sold off some mines. It's probably unusual. Look at this revenue, $12 billion in revenue. That one's flying higher. They must be doing a lot of write-offs and crap to knock down their taxes or something, because this doesn't sound right. You know, that would take a lot of looking into to figure out why they're not making more money when they're selling so much more gold. Doesn't really make sense, does it? So there's got to be something going on that they're doing write-offs or other stuff to knock down. But God bless them. Hey, if you own the company, you want them to do that and avoid the taxes. So the enterprise value is put up at 52 billion. So they're still trading well under what they're considered worth. But the bottom line is, to me, I don't think they're going to make less than I don't think they're going to make less than $2 billion. That makes this about 20 times earnings. Worst case scenario, they could drop 50% back to 12. That's incredibly unlikely, but that's where we think there's a real floor for this thing. So if I'm going to buy Barrick, I'm going to want to scale in, right? I hope they come back to 1650. I don't believe they'll come back to 12, but they went to 12 in March. Doesn't matter what I believe, that's what happened. They were 11 last year. So the question is, how much Barrick do I want to have? Now, if I have an allocation block, and let's say my allocation block in my portfolio for buying Barrick is $50,000, right? So I could buy 50,000 ultimately Barrick. Now, 50,000 at 1250 is going to be what, 4,000 shares, right? 4,000 times 1250. Yeah, that's right, 50,000. So ultimately, I'd like to have 4,000 shares, basically. How do I engineer? It's at 24 now. I'd like to buy 4,000 at 12. All right, so how do I do that? Well, use options. So step number one, I'm going to obligate myself to buy 1,000 at a very low price. So I'm going to say, okay, so to start off with, I'm willing to buy 1,000 at 20. All right, so and it won't be 20, it'll be net 17. So I'll sell these for 3. So if I sell 10 of these guys for $3, let me write this down so I don't get mixed up. I try to remember these things and it never works out. So if I sell, let's say, 10 shares of gold and sell a 2023 $20, so sell 10 2023 $20 puts for $3. Okay, that's going to be $3,000 credit on that. Then step number 2. Now I don't really believe it's going to go that low, but I'm willing to obligate myself to do that as my first play. Now, I think this is a reasonable price right now for Barrick. So what kind of spread is going to be reasonable for me to take? Well, what's my realistic target? What do I think they're going to be able to do? So I think probably this is, I think we're low in the channel here. I think this was too high. I already said that. So let's say they get back to the 50-day moving average at 26. Let's say we target 26. Just arbitrarily. Let's figure they grow into that valuation. So now I'm thinking if my target's 26, let's call it 27 in 2023. So now I'm already saying, I know what I'm going to do. I'm going to sell these guys for $420. I'm going to sell the $27 calls for $420. And what am I going to buy? Well, look at this. I can buy the $23 calls for $555. If these are $420 and these are $555, that's $1.30. Actually, these are $425. If I can have $1.30 on a $4 spread, what the hell else do I need in life? How is that? That's so great for an entry position. Now, so I've discovered that this is really cheap. Then I say to myself the same thing we always say when we're looking at rolls, right? What happens if I take the 20s instead of the 23s? Well, it's going to cost me, instead of $555, it's going to cost me $7, let's say. So it's $1.50 for me to roll $3 lower to the 20s. All right. Now, that would widen my spread, obviously. And the question is it worth it though? Do I really need to do that? It isn't really worth it because I have no need to lay out this money, because if Barrick goes lower, I can always do that roll for less money. That's my maximum price right now is 50 cents per dollar to roll down. If Barrick goes lower, I can certainly recoup that money, but I would rather have more of the spread now. So instead of spending more money now to have a better strike, why don't I just spend twice as, instead of spending $1? Don't forget the whole spread's only $1.30. So I could spend another $1.50 and get $3 more strike, or I can spend another $1.30 and get twice as many shares, which is a $4 spread. So I'm better off buying more of the spread. So we're going to put our firepower into the 23-27 spread, and I've got $3,000 for free. That means if I buy 20 of these spreads, it's going to cost me $260. Is $2,600. I'm sorry. If I buy 20, yeah, it's going to cost me $2,600. I actually have a net credit if I buy 20 of the spreads, because I'm going to buy 20 of the 23-27 spreads for $1.30, and that's going to be $2,600 total dollars. And then I've got what? I've got an $8,000 spread that I'm getting a $400 credit for. All right. Well, that's great, obviously, and I'm not going to discourage that behavior, but what I'm going to say is, why not go 30? So because 30 of the 2023, it's a 23-27 bull call spreads, or at $1.30, is going to cost me $3,900, right? So now my net on the spread, because I sell 10 of these guys, sell 10 of the 20s for $3,000 credit. I buy 30 of the spreads, the 23-27 spreads for $3,900. So now my net cost of the entire trade is $900. And what do we have? We have $12,000 in the spread. Okay, and keep in mind that that's a $12,000 invested in the 23s that are already $1 in the money. So we have with $3,000 in the money, we spend net $900, and with $3,000 in the money at $24, and the puts are way out of the money. So that's the way we want to look at it. That's a good spread. Now keep in mind, what was the point of this though? I'm saying that's my initial entry into Barrick. So I'm saying right now, I'm looking at Barrick Gold and I'm saying, gosh, I would totally love to own that. Where's it? You know, I'd love to own them again for $12 or $16. I'd like to own 4,000 shares for 12, for sure. No question about it. So what is my commitment so far? My commitment so far is I spent $900 out of my $50,000 potential allocation. I spent $900 in cash, and I've obligated myself to buy 1,000 shares at $20. So I've obligated myself to spend $20,000 for 1,000 shares. That would leave me with 20,900 really, because if I lose the 900 as well. So if everything goes badly, I'm going to lose $20,900. I still have $30,000 left, $29,100 left. Under what circumstances would I be losing? Well, Barrick would have to be below 20 for us to take a loss, right? We're not going to take a loss unless Barrick is below 20. Not a loss of more than 900, which is effectively inconsequential. So if Barrick's below 20, that's when we start losing money. So what's really my worst case scenario? My worst case scenario is Barrick's down at 16. The worst likely case. So Barrick's down at 16. So what do I lose then? We have $900 loss, right? And then we lose another 4,000 at 16. At 12, I'm sorry, not 4,000 because it's 30 shares. We lose $12,000 more dollars at 16. So our worst case scenario is $12,900 loss. So what am I risking? I'm risking I'm risking 1/4 of my allocation block of $50,000. I'm risking $12,900. My potential win on this trade is $11,100 if it goes straight up. So my reward is about equal to my risk. But the thing is, since I really want to own Barrick Gold, what's going to happen if it goes to 16? Okay, I'm not going to just go, ooh, I lost $12,900. I'm going to say, oh my God, I get to double down on Barrick Gold at $16. How am I going to double down? Same freaking thing we just did. I'm going to sell more puts for $3, which will lower my basis from 20 to 17, right? If I sell more puts for $3, I'm going to lower my basis from 20 to 17. Now I'm obligated to own 2,000 shares, but at around $17, let's say. All right. Do I want to own 2,000 shares for $17? Absolutely. You're telling me right now you're going to let me buy 12,000 shares at 2,000 shares of Barrick for $17? Absolutely, I will take that deal. And then I would be using $34,000 of my $50,000 allocation block. And then what happens then? Then I can lower my basis again by another $3, and then I would end up owning 4,000 shares for, let's say, $14. So you see, my obligation now, I'm saying right now, I can buy, I definitely want to buy Barrick for $12.50. I just said that. But as this trade works out, if everything is a complete disaster and it keeps going down, I will end up owning, with my $50,000 allocation block, 4,000 shares of Barrick at about 17. And again, we don't know exactly what the prices are. You don't know if we're going to lose, that we'll lose it all. We might sell calls and puts along the way. Who knows what's going to happen? But the base case of simply taking this spread, losing our asses, and sticking with it over the next 4 years probably, is that we'll end up over 4 years owning our entire $50,000 allocation block will be used with 4,000 shares of Barrick. And when push comes to shove, if I end up owning 50,000 shares of Barrick, I'm sorry, 4,000 shares of Barrick, and I spent my 50,000 allocation block, I own it for $12,500 per $12.50 per share. You know, there's going to be wins and losses along the way. Maybe it'll be 60,000, maybe it'll be whatever. It's okay. But the point is, I'm on my way to hitting my goal. And don't forget, by the way, that when it does crash, the option prices go up, and we'll get better prices on the further sales. But that's how you initiate a position. Even in a bull market, you can take a position like this, especially when you absolutely know you want to own for a cheaper price, and you take a very small position. All right. So don't forget, the position we're taking is we're selling 10 of the 2023 puts, of the $20 2023 puts, and we're buying 30 of the 23, 27 bull call spreads. So if we don't get to own our 4,000 shares at $14, if that doesn't happen, then what will happen? Well, I mean, there's in betweens, but of course, if we don't get to own if we don't get a disaster and we don't get to own our shares cheaply, and Barrick keeps going up, then we're going to make $11,100. And how much am I doing? I've got my $50,000 allocation block. So I'm going to be, without actually utilizing the allocation block, we're only using a small portion of it, and very, obviously 900 in cash and very little in margin. The net margin on this would be very low. But we use 900 in cash, very little in margin. So we're not really using our allocation block, but of course it is assigned to Barrick Gold. And then we are going to, if it goes up, we're going to make $11,000. And that's a hefty return. That's a 20% return on our unused allocation block. So honestly, we would rather if it went down lower and then came back up, that would be more fun, because we're committed. We're committed to doubling down. We're committed to rolling. We're committed to adding to the position. So when the market drops, when the market drops and Barrick drops, unless of course something drastically changes, but when that happens, we already know we want more of the stock. That's what we're doing with our money. That's our plan, is to take our allocation of cash that we have in the long-term portfolio. Oh, where's that? There it is. Da, 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 da. So we got short-term portfolios on 32%. We have mountains of cash in the long-term portfolio. which is now up. It's just funny. Wow. This is so stupid. We have $800,000 of cash ready to deploy. Don't forget, we started last year. This portfolio started 10/1 of 2019 with $500,000. And now we have 1.4 million in value. We have 800,000 in cash. So even if that was our total portfolio, we'd be thrilled. That's our freaking cash now. We can just walk away and be done. I mean, that's as much money as you really need to make in 2 years. You don't really need to work anymore. So our cash position is gigantic. So we say, what are we going to do with $800,000? Well, we're going to have 1.6 million in buying power, and we're going to allocate it to new positions. Now, of course, we already have a bunch of positions, so we have to take into account what our obligations are. But then we have the last portfolio review. Here and here. And let's see, when did we do our portfolio review? Oh, nope, had to be this week. Here we go. Okay, see, this is what's crazy. This was on December 17th, so 3 weeks ago. We had 1.5 million total in our long and short-term portfolio. The short-term portfolio was actually worse off at the time. The long-term portfolio, that's not the long-term portfolio. Oh, well, it's somewhere in there. Oh, it was the next day, that's why. Okay. Anyway, well, the long-term portfolio was whatever. So, anyway, the total of the long and short was 1.535, and now just the long-term portfolio is 1.45. And the short-term portfolio is down 32%, so that's got to have 1.6 left, 160,000 left in it. So let's say 160,000 plus this is 1.5, and 160 is 1660, let's say. All right. 160, sorry, no, 1516. So it's about 16 now. The total of two portfolios is right about 16, a little bit higher than 16. And we were at 1535. So we're at $65,000 more in a few weeks. And don't forget, again, it started as a $50,000 portfolio, so we're getting 10%. And we're mostly cash. We're $800,000 in cash. We hardly have any positions. The positions that we have are gaining ridiculous amounts. That's what's crazy about this, is that we've only left ourselves, well, now it's 600, but we made this gain of $60,000 on $60,000 of positions. They're up 10%. The whole portfolio is up 5%. These things are up 10%. That's insane. This market is completely insane. It's just like throwing money out. So, you know, but that's how we take advantage of it. And there's we don't really have any positions that are losing. You know, I mean, that's one thing we were. Oh, here you go. So MJ, well, hard to say, but the MJ, unfortunately, the MJ ETF is mostly Canadian stocks. It's not doing badly, but it's just, at least it's got some rough edges. Here you go. This is the IMAX. So IMAX is still playable, but that's a little bit risky. I'm not sure I would be in love with that. Goldman Sachs is dogging, so they're not great. I'm just looking at like who doesn't have a big win yet. China Mobile, of course, is delisting. We're still sticking with it. You know, we're going to see how it plays out, but it's a very small commitment for us. We committed to buy 1,000 shares at $30 in 2023. I don't mind sticking with that, but you guys have to keep it in context. I know a lot of people have been wringing their hands about this, and the bottom line is, no, I would not do it if it was a major portion of my portfolio or something. I wouldn't want to risk it, but we're talking about being forced to own $30,000 worth of CHL in a $1.5 million portfolio, and I think it's probably going to come back. So I'm willing to risk it, but it is a risk. You could get wiped out of this position. So the position is currently, it's net credit, and that's the other thing about this is you have to understand we're not even risking $30,000 because we currently have a net credit of 12 and 6 is we have a net $3,000 credit, so we're risking $27,000. That's the most we can really lose on this trade. That is not a huge risk. But if it was $270,000, no way, I'd get the frick out of this position. If it was $150,000, I'd get the hell out of this position 10%. We're talking about risking 2% on the portfolio by keeping our China Mobile position. That I don't mind risking, but it certainly is risky. All right, but what are we going to do? We're going to buy back the short calls or at a certain point, we're going to buy back the short calls. We've got our 2750 calls. We're going to roll them down, but we're going to wait and see what happens. We're going to just wait and get more information. But look how much they've lost already. If we double down on those and this thing works out, it's going to make a fortune. So I don't want to get rid of it. It's a terrible performer. We're down 15. We're down 10,000 bucks on this position right now. But the most we can be down. That's another point about it. We're already down $10,000. The most we can end up being down is 27,000. We can only lose 17,000. That's our risk. You got to realize that also when you're in a position, and I'm not saying you do it for the hell of it, but when you're in a position that you think might come back, and you've already lost $10,000, and the most you can lose in the position is $27,000, you're not risking $27,000. The 10,000 is freaking gone. You're risking the 17 that you haven't lost yet. That's your maximum loss right now. Obviously, though, if I'm intending to stay in it, I better be expecting to commit more money. But how much am I going to commit? Well, I'm going to commit another 6,300 bucks to double this down. That would be my primary goal in this thing. And if I do that, I'm then at risk of losing 17 plus another 63. It's $23,000. Am I willing to lose $23,000 on this position? Well, yeah, sure. Because that's 3% of my total portfolio. Not even. It's not enough to worry about. It's a gamble position, and we don't have many gamble positions. We don't really have, honestly, I don't think we have any gamble positions in this portfolio. This portfolio is rock solid. Why? We purged everything that we were worried about over and over and over again. We purged every position that we don't want to hold on to in a crash is not in this portfolio. But everything here we are happy to double down on. But what does that mean? That means it's $800,000. We need $647,000 to double down if it goes the other way. These are the positions we want to hold if the market crashes. If the market crashes, these are our all-stars. We don't think anything bad. We don't think anything long-term bad. Harmony Gold, if we're forced to own it, we're fine with that. And by the way, it's 50 times $3 is 15,000 bucks. Worst thing that can happen, we own 5,000 shares of Harmony Gold at $3. That's our worst case. Fine with that. All American Pipeline, we have 8,000 shares. We actually have the shares. And again, natural gas pipeline, we don't really see a problem with this. And and by the way, we have this one set up. We're going to get called away at 5, and it's at 9. So it would almost be to our benefit if it goes down and we get to buy back the callers and keep the stock. Berkshire, of course, we had some puts and whatever, and we bought those back and did some stuff with this. Berkshire Hathaway, obviously, you know, anytime the market rebounds, you're happy to own Berkshire Hathaway. Cisco, no problem owning Cisco for the long term, especially with 5G and everything coming around. Foot Locker, people wear sneakers. I'm not worried about that one. Gilead, as we know, good drug company. Oh, there's a good one to buy. They're still cheap. So that one's definitely good to buy. Goldman Sachs, always, I mean, they make money no matter what happens. IBM was our stock of the year a couple of years ago. IMAX, always in the running for stock of the year. Whenever it's cheap, it's cheap now. We're not sure the timing of when these movies and things come back, and we will see. Intel, of course, we've had debates about that, but they bounced back nicely actually. So I think people are going to stop telling me I'm an idiot for having Intel. I hope. Oh, what was that? I just made up a symbol. INTC. There you go. So I was getting cursed out when Intel was down here, and I kept telling people I like it anyway. It's the same thing with China Mobile, but we'll see. Where was I? That's not it. Where were we? Oh, here. Macy's, of course. Look at freaking Macy's. Jeez. What the hell happened to them? That's funny. I didn't even know they wanted to do that. Oh, that is funny. All right. Anyway, so Macy's is another one I kept telling people I like, and everybody's like, Macy's? What do you like Macy's for? You're stupid. Where are we? Macy's, the marijuana ETF. As I said, the problem with the marijuana ETF is these are Canadian companies. There isn't a U.S. marijuana ETF. I would definitely invest in a U.S. marijuana ETF right now. This one will, obviously they're doing well, but they would do a lot better if they were U.S. companies. And especially with the Democrats coming in and they control the Senate, we could get a national legalization of cannabis. That would be amazing. 3M, obviously good, and the pandemic rages on, and the PPE supplies are in demand. Philip Morris, again, people like getting high, and and actually the Philip Morris is a good way to play American legalization also. Pfizer, of course, vaccine, no problem there. SKT, and again, if you're going to shop outdoors. And they are on a rager too. Look at this crap. Holy cow. How did that go from being a dog to doing that? I tell you, man, I picked some good stuff. Look at that. So funny. All right. And I mean, obviously it's stupid because everything's going up, whether it's got merit or not, but this is pretty nice. And then we got Simon Properties. It's the indoors. So we got outdoor malls, indoor malls, solar, sun power. Obviously, I like them for the long term, and I'm sure Biden's going to be pushing the solar and doing whatever they can to start reining in the emissions. AT&T, of course, again, when that was just, anytime AT&T is below 30, just buy it. It's not complicated. It's a freaking phone company. And then, of course, Walgreens, which is another all-star pick that I have, and it also is taking off now, so I don't think anybody's really questioning that one anymore. And that's it. I mean, boy, those are good stocks. Every single one of those stocks is great. Every single one. That is a bulletproof portfolio. I hate to say that because it's like a jinx, but that is a freaking awesome portfolio. No wonder it's up 180%, or 190. No, nothing should be up 190%. That's just insane. But this is what the best case scenario is. But think about it, because what we just talked about on the Barrick Gold one, right? How much would that be up? If that does well, like these are doing well, if it blows through $27, that position will be up 200, 300, 400, 500. It doesn't stop. It can go 1,000% up. It's still not done, because $900 turns into $11,100. That's more than 1,000% upside on one position. That's why you get these crazy gains. We turn $900 of cash into $12,000 on the Barrick Gold trade. If it goes well, we don't expect every position to take off and do that, but that's what basically happened this year. All of our stocks are doing well. We purged the ones that weren't doing well. We're only left with the ones that we felt very strongly about after seeing them battle tested through the downs and through the ups. We are only left with the ones that every time I went to purge, I said, I'm going to cut positions. And I'd be like, damn it. Because I get the long-term portfolio and I'd be like, damn it, they're all too good. I can't cut them. We did cut a lot. We cut all of our short puts. There's barely any short puts left. We don't have a lot of commitments to the downside other than what's inside these positions. But all these are stocks we totally want to own, and we want to own them for the long term. And that's how you build a portfolio. And by the way, looking at these positions, you know, it would be tedious to do the math, but looking at these positions, we've done that already in the last couple of reviews. This portfolio still has like $100,000 to gain as it stands now. So if the market keeps going up, we're going to make another freaking $100,000. I'm not $100,000. What am I talking about? More like 500. Another 100% is left to gain on this portfolio. 100% more. Why? Because these are 400 or 500% positions, and they're not fully realized yet. Look at Gilead. Gilead is 94 minus 44 is 50, obviously, minus 10. So let's say it's a $40,000 position, roughly. And how much could it be? Well, it could be 50 times 15, $75,000. So here's a $40,000 position that can become a $75,000 position if Gilead is over 65 in 2023. That's all it takes to make 100 and whatever the hell percent, more than 150% from where it is now. And where it is now is already up from where it was. We started at net 49 minus 940. We started at net 40. Well, it's not much different, but we started at net 40, and this is a potential $75,000 spread. 45. I'm sorry, it's not. It's a $100,000 spread. 45 to 65 is a $100,000 spread. So this thing can make 200 or a profit of 150% from where it is right now. How easy is that? I mean, it's just, that's what these positions are like. And all Gilead has to do is justify $65. And if you look back at Gilead's chart, look where they are. Why are they down? They're down for dumbass reasons. They have to get to 65 in 2 years. And they're down here. And this is right now, you can put $40,000 into this position and get $100,000 back. Right now. It's on the table right now, available to you. And these are the lows. What's our worst case in this position? Our worst case is we have to buy 1,000 shares of Gilead for $62.50. That's our worst case scenario. On the put side, of course, we have a $40,000 spread. So what's our realistic worst case scenario? Well, realistically, let's say that we take this is the spread. This isn't going to see. This is only making a very small amount of difference, right? It's going to be easy to stop this out with a $10,000 loss. It's a $40,000 position. If you cut this at $10,000 loss, what are you doing? You're adding $10 to this cost, so $72.50. Your worst case is owning Gilead at $72.50. Now, you say, well, Phil, that's a pretty bad case because Gilead isn't at $72.50, is it? But $72.50 is still what we think it's worth. So our worst case is owning 1,000 shares of Gilead at $72.50. And let's say it goes down to 50 instead of up, right? Then we'd be down $22,000. And again, how much is that? That's 1/2 an allocation block. So we're risking half an allocation block to potentially make, now 1/2 an allocation block being $25,000, right? So we're risking $25,000 in our portfolio against the possibility of making $60,000. So it's a good risk-reward ratio. It's a stock we firmly believe is undervalued, and it also and also we really don't believe in the downside. We really don't see that downside playing out. So high percentage of success, that we believe it's a high percentage of success. We believe it's a positive risk-reward ratio, so on and so forth. That's what makes it a good play. That's why it's still in a long-term portfolio. I don't give a crap how low it goes here. I don't care if sentiment shifts. There's nothing wrong with the actual company. You know, what happened to Gilead? They didn't have a COVID cure. And so people sold them off as if that's like the only reason the company the biotech should exist. Today they're up 3%. $75 billion market cap at 61.75. How much money do they make? They make 4 billion, 5 billion, 5 billion, projected to make 8 billion this year. And this year is not, you know, we're at the end of the year. They're not going to be far off. And 8 billion next year. They're making $8 billion with a $75 billion valuation. That's idiotic. Okay, they should be the stock. They should be the stock of the year, and I think they would have been except they were up or something. I was actually they're in contention for the stock of the year. What was going on in November? Oh yeah, that's right. So in mid-November when I did the pick, they were up here again, which is where they are now, and I was pissed off because they were in contention, but I didn't want to pick them after they just popped up. But it turns out, well, it doesn't turn out anything. They're still in the same position. I mean, they're back here, back at 55. Should have bought them again right there. Should have put our foot down. But we already have them. There wasn't anything to really put our foot down about. Although we did, look what we did. It's 11.17. I don't remember what the move was, but we did something to expand our position at this point. I don't remember what we did, but for whatever reason, we definitely added a bigger spread at that point. But that's what this is. This isn't that complicated. Okay, we're picking. These are not stocks you're like, oh, I never heard of them, or I don't know what they do. This is freaking Cisco, Berkshire Hathaway, Foot Locker, Gilead, Goldman Sachs, IBM. This is a total blue chip pussy portfolio. I'm not taking risks here. I'm not going out on a limb and playing stocks that I don't know what's going to happen to them in 10 years. In 10 years, they're all going to be in the same place. These are like the bluest of the blue chips. This is the dullest portfolio you could ever play, and it's up 190% in just over a year. You don't have to take a lot of risks. You don't have to play fad stocks because these options are crazy how they pay you off. Barrick Gold, $900 turns into $12,000, playing the best gold company in the country. Gilead, one of the best biotech firms in the country, pharmaceutical too. I mean, they're basically on the cusp. You're playing them not to be lower than they are now. If they stay at 65, you're going to make a freaking fortune. I'm playing Gilead not to be lower than a PE of 10, where they are now. I think Gilead can hold on to a 10 PE ratio. What do you think? And if you agree with me, you can make 150% in 24 months. Not taking a big risk. I'm not going all in. I don't need to. If I don't need to, in this kind of market, with these kind of VIX, the VIX ratio, which is really pumping up the options prices, I don't need to take a risk, so I don't. We've had other markets where we've played riskier positions in the years back. Why? Because the VIX was very low, and it's been low for many years. But when the VIX is not low, we have the advantage of being able to take a regular blue chip boring stock and just say, I don't think it'll be lower than that. Here's IBM. 53 minus 37 is what? 20? Nope, 16, right? Only 16, and then minus 10 is 6. So this is $6,000 roughly on a what do we got here? On a $50,000 spread. $50,000 spread. It's net $6,000. What does IBM have to do to pay you a $44,000 profit on $6,000? What incredible circumstances have to occur for you to make, what, 8 times your money back, okay? Well, IBM has to not go below 125 bucks. It's already at 131. I'm betting, it's almost stupid, isn't it? I'm betting $6,000 that IBM will stay above 125 for 2 years, and if I'm right, it's going to pay me, I'm sorry, $30,000. It's only 15. I thought it was 100. it's going to pay $30,000. So $24,000 profit, only 400%. So $6,000 turns into $24,000 if IBM holds 125 and it pays 400% in 2 years back on your money. What's my worst case scenario? IBM, 1,000 shares are assigned to me at $100, sorry, which would be a 30% discount to the current price, but plus 6,000, so I'd really be paying $106. So my worst case scenario is owning 1,000 shares of IBM at $106. So in my mind, I'm saying, do I want to own 1,000 shares of IBM for $106? Yeah, absolutely. Not even a tiny, again, this is that stock of the year a couple of years ago. Not even the tiniest question. I think IBM should be about 150, and it's at 131 now. There's no possible way I don't want to own that. I will sell many other stocks to get that if I have to. Therefore, I have no reason not to play this. My worst case scenario is something I would love to do. I would love to be able to own 1,000 shares of IBM for 106. I'll be disappointed if I make a profit of $24,000 and I don't get to own IBM. I'd rather own the stock at 106. I'd rather have 1,000 shares at 106, which would actually be a $24,000 profit at 130. I'd rather have 1,000 shares at 106 than just get 24,000 bucks for not owning it. But that's what's going to happen. If it's above 125, we're going to have to take 24,000 bucks and say, sorry, you don't get to own IBM. Go away. But why would I not want that? My bet is IBM doesn't go lower than it is right now, and I get 400% return on my money. You know, I would like to get, I want to get you guys to embrace the simplicity of what we do. Let's not pretend this is complicated. This is not complicated. What's complicated is everybody chasing bullshit. That's what's complicated. Everybody wants to go, what's hot? What's this? Let's bet on that. Let's bet on that. Why? That's not what being the house is, okay? Being the house is taking the simple bets. I'm betting against other people. I'm betting against the guy who says IBM's going lower. And I'm betting against the guy who sells me a freaking IBM $100 put for $11.75 for 10% of the price of the stock. I'm netting in for 90, not even 80, whatever, 88.25. I'm netting in for 88.25 by selling the $100 put, which you can't do anymore, obviously. Well, now it's still $9.90. It's still 10 bucks. I'm netting in for 90 bucks, even if I do it right now. That guy's an idiot. There are many, many, many idiots out there. This guy is one of them. The guy who sold me these, the guy who sold me these puts, getting me to promise him that I will buy IBM for 90 bucks, is an idiot. And that guy's out there right now. Right now, he'll give you 10 bucks to promise to buy IBM for 100 bucks. Take his money. He's an idiot. Take it. Let him give you the money. It's not complicated. And what am I doing? I'm paying net $6 for the $15 spread. So forget the short puts, but I'm paying $6 for a $15 spread. That's got 150% upside, $9 potential upside, right? I'm paying $6, $19 spread, and I'm sorry, $15 spread, and all IBM has to do is not go lower. Okay. I would be an idiot paying $135 when IBM's at $110. If I pay $25, although it's not really a terrible, it's not a terrible margin, it's not a terrible premium. It's only a few bucks in premium, but I take advantage of that fact because we're willing. See, most option players want to buy the cheap calls out of the money, and that causes the short call prices tend to be inflated because more people want them, and it's kind of an auction. It's kind of a bidding process. People don't want to buy in the money calls. Why? Because most people playing options are trying to take a little teeny bit of money and make a ton of money. We're not doing that. We're taking the position. I do want to own IBM. By going to the 110s, we cut our premium and paying $25, it's $26.80 now. So by paying $26.80 for the 110s, we're paying $136.80. So we're paying $5.50 in premium right now. We buy that right there, we're paying $5.50 in premium. But what do? We turn around and sell $18.65 in premium. That's a $13 profit. We bought $5 in premium, we sold $18 in premium, $13 profit in premium sales. Being the house. $13 times 20, $26,000 in profit, in premium, and all IBM has to do is not go lower. That's all we're doing. It's not complicated. The base concept is not complicated. I didn't even want to say picking the stocks. To me, I understand that, I've been doing this for my whole life, basically. I understand that picking the stocks, finding the actual positions, that you need to get used to it. But I'm just telling you the basic concept. If you practice it and you stop getting distracted by this bullshit that goes on in the market, just stick to what's really working. Stick to the stuff that's obvious. And I know you read about this exciting thing and that exciting thing. Oh my God, I wish I could show you this. Oh, I can't believe I forgot to do this. Where is my frickin' phone? Oh, it's charging. Damn it. All right. I'll just tell you. My cousin somehow in England found my grandfather's 1912 or something like that school registry. And I'm saying from memory, so I'm just trying to remember what it looked like. So on the registry, it had the names of the students, it had the names of the parent who's responsible for them, all handwritten in script. You could barely read it, but beautiful script. But these days we can't even read script anymore. So it was very interesting though, because it had the dates of birth, the date of registration in the school, and they were all the students that were going into the school that year. But then the best thing about it was the parents, it listed their occupations. It also listed nationalities, and it was funny because for everybody who was Jewish, it just said Jew. Like a Jew. I was like, holy shit. I mean, that's in your school registry. It says Jew. That's what you are. Because it didn't matter. It's funny how it didn't matter where the Jews came from. They were like, it said French, Czech, this or that, but then it said Jew. If you're a Jew, forget your nation, forget the nation, you're a Jew. That was in England. That was London. That wasn't even like the suburbs or anything like that. It was right in London. That was how they did things. But the occupations were killing me. They were like, first of all, there were lots of tailors. You kind of don't realize that. Back in the day, there was no Gap. And nobody in China was making your clothes. All your clothes were handmade by somebody in your neighborhood. So interesting. I think it must be interesting also, like in those days, you got to imagine like people who lived in different places had totally different clothing, right? Like clothing would spread like regionally maybe, but be very, very different from place to place. That's kind of cool when you think about it. So a lot of people were tailors. I found that interesting. My grandfather's father was a tailor. He owned a tailor shop. So he was something better than a tailor, but he was anyway. But he was a tailor basically. And there were lots of tailors. That's what made me notice that. There were also a lot of publicans. I couldn't figure out what a publican was, but it turns out a publican is a person who works in a pub. So that was another major occupation. There was a silversmith. There were very few professions, or what you would call professions, mostly laborers. Most people were laborers of some sort. But there were things like Silversmith. There was a blacksmith. There was a fishmonger. There were a bunch of fishmongers. I found that only one butcher. Apparently, being a butcher must have been prestige. There was one butcher, and of course, it's a sample of 100 students I was looking at. It doesn't mean that it's a good sample, but you never know. And there was a butcher and fishmonger, though. There were a lot more fishmongers than you would have thought, but I guess that's because, if you think about it, in 1912, there's no factory farms, and England is an island where people eat a lot of fish, because people would eat fish because that's what you can get in England. So there were lots of fishmongers, and that was people basically sold fish. So it was, but I thought about that, and I looked at it, I said, 9 out of 10 of those jobs don't even exist anymore. Or, like nobody does this anymore. And that's crazy, right? 100 years later, and 9 out of 10 of those jobs don't even exist. And we worry about this unemployment and things, getting the industry is getting disrupted and stuff, but people adapt and people change and people do whatever. So I found that very interesting. It was just looking at this registry from 100 years ago. I'm thinking like, wow, all these people, if you said to them, here's today's society, they'd be like, well, where do I sell my fish? What do I do? It doesn't work that way, though. People adapt and move and change in ways that you don't even notice. And that's what I'm talking about, these blue chip companies. When you pick up these blue chip stocks, you don't have to chase the fads. They don't have to sit there like they didn't have to. Now, it would have been smart, obviously, to invest in the Ford Motor Company, right? Because that went on like gangbusters. And that's like our Future Is Now portfolio, right? Where we pick stocks like that, although we pared that down considerably. So I decided most of these have run their course. But we had SunPower, of course, SunPower twice. We had Jets, the airlines, CN, and we have Square, the payment system, Plug, and ALB, another pharmacy, another pharma company. Oh no, they're the metals. Sorry, they're metals. Anyway, so stocks and things that are going to be used in the future. Now, you could chase all that stuff, and we did very well in this portfolio. It's up 100%, and we only started it in, we started this on my father's birthday. This was in honor of my dad's birthday on 12/12, because that's when he was born in 36. So my dad's 12/12/36, not long gone, but so he saw a lot of stuff too. What a life to live, all these guys, I swear. The changes, although look at us, we're going through this massive crisis. I mean, one day people look back at that and be, how'd you survive that? So, this is a different kind of portfolio where we're looking at the future and picking future stocks. But even if we're smart, even if we pick SunPower, which was an amazing performer this year, even if we pick Jets at just the right time, amazing performer for us. All these did well. Every single position is a winner in this portfolio. That's another way to play, but it shouldn't be the only way you play. That's what I'm talking about. You've got to look forward, but you don't have to chase these stocks. Like I said, my grandfather could have bought Ford because motor cars were obviously going to be a thing, but he also could have bought RCA, which is dead now. He could have bought Tesla, who went bankrupt. That Tesla went bankrupt. He could have bought an airplane company. Maybe it would have been a winner. Maybe it would have been a loser. Chasing the tech, right? But if he bought something sensible like a tea company, or he bought something sensible like the East India Company is dead now too, but it turned into something. If you bought ExxonMobil, knowing that they were a huge oil drilling company, it was a Standard Oil at the time, so Exxon was Standard Oil back then. You buy things that are you do just as well with the things that are just very obvious. I had a stock. My grandfather gave me, I don't remember whatever happened to that, but I had a certificate for the Panama Canal Company. That was cool. I had a stock certificate for the original stock certificate for Panama Canal Company. That's one to buy, right? Because again, they're building this giant canal that's supposed to last 100 years. It's like, it's probably a good investment. It's probably going to be around for a while. And that's what Biden's doing that too. Biden's going to bring back infrastructure. There's a lot of heavy betting on infrastructure plays. Anyway, let's do some Q&A and see what people are talking about. I know the Fed did their thing, but who cares, frankly? I mean, honestly. Here's the Fed. Let's refresh. Oh, wait. Oh, is this not even going to go to this year? 2021. Oh, no. Wait. Oh, because the minutes. Oh, okay. Minutes released now. Okay, here we go. Oh, this is going to be. I can't do it. It's too tedious. I'm not in the mood. Staff review of the economic situation. Let's look at that. GDP was increasing at a moderate pace. Labor market improved. Consumer price inflation was below the long-term rate. Restrained by declines in energy prices and the prices of non-energy imported goods. Now, notice that. That's interesting because that's a big change. Energy prices have shot up since this report. You have to keep that in mind, that the situation is not what it was a few weeks ago when they had this meeting. So if they start changing their mind about inflation, they could change their mind about the whole market and what they're doing. How are we doing here? Yeah, coming down a little bit, but not much. Non-farm payroll, and again, non-farm payroll expanded. Now that's why I said this morning, though, that was positive that you have a slowdown in the jobs because it keeps the Fed on the table. They supposedly care about employment, maintaining employment. They supposedly care about keeping inflation in check, but in check doesn't mean only lower. In check means it should be higher. That's the thing. So right now they want more jobs and they want more inflation because it's too low. Inflation can be too high, it can be too low. They want 2% basically. The share of workers employed part-time was flat after declining. The rate of private sector job openings, hires, and quits were little change in October from the average levels. So in other words, we haven't been gaining much jobs now. If they're going down, we've got some serious problems. But we do have serious problems. You know that. And it's like I said, the most important statistic, I think, economically, which I talked about, I think, earlier this week, the most important economic statistic to me is that 25% of small businesses who employ 60% of the people in this country went bust. Now, back to what I just said about the job situation in 1900. Those 25% people mostly go out and get new jobs. They get another job in another industry or do another thing. And the fact that that business went bust in 2 or 3 years is completely absorbed into the economy. We're very adaptable people. But nonetheless, in the short run, we are drastically affected by a 25% drop in small businesses, not just affecting the employees, not just affecting the 15 million people who get dislocated. 15 million people got dislocated from their jobs. Okay, the business owners themselves, probably about 1 million of those people, are devastated. They go from upper middle class small business owners to no job people. That's bad. That's a tough segment to get back. So just because they go and get a job doesn't mean that things are good. Okay, then those people can't pay their rent. The landlord then doesn't have money. If he can't replace those people with new industry, and that's not coming, there's not a big burst of, see, this dislocation, it's not a dislocation of new businesses disrupting old businesses, it's dislocation of business going lower. Overall levels of commerce have dropped. Businesses are shrinking and closing because there is less economy to have, so you don't need so many businesses. That's a problem. So you have 25% of small businesses went out of business last year. 30% of the remaining 75%, so 1/3 of the remaining 75%, which now will take out another 25%, leaving you with what? 50%. 1/3 of the 75% that remain say they can't make it 6 more months. And the amount of stimulus they got last time didn't help because 25% of the people still went bust with the stimulus from last time. And this stimulus is less than last time. It's not going to work. How are they, if they're not going to make it 6 months, what's going to change in 6 months? Then you have to start doing the math. Then you have to say, okay, well, how many people can we vaccinate? Well, we were told that we could vaccinate everybody in 6 months, but in fact, 1 month into the vaccination program, only 3 million people have been vaccinated. Only 1% of the people in this country have been vaccinated after 1 full month. That's a disaster. Can you imagine if there was a virus that was killing people at a faster rate than this? Could you imagine if there was a virus that was spreading faster than this virus and we had to act immediately and the best we can do is vaccinate 1% of the population in a month? It's pathetic. And it's not like we didn't know we had to vaccinate people. We've been planning on vaccinating people for 6 months with Operation Warp Speed. What the frick was the plan? There was no plan. They don't have anything ready. They didn't have any way of doing this. If you want to do something, could you imagine if they were doing the invasion of Normandy? If they were doing D-Day, and like the day before D-Day, they're like, "Hey, we're gonna need some boats, We gotta put these soldiers in some boats. Otherwise, how are they gonna get there?" The general's like, "Oh, damn it, didn't think of that. Holy crap! We got the soldiers. We just didn't have any boats. Oh, guns. Anybody get guns? Let's go get some guns." I mean, that's how this is being planned. That's effectively what's being done with this vaccine. It's completely ridiculous. You can't be more incompetent if you try. The only way you could be this incompetent is for someone to lay out a plan for how to completely and utterly not respond to a pandemic. And you follow that plan. Somebody would have had to put a lot of thought into how badly this pandemic is being handled. And that somebody is Vladimir Putin. I'm telling you, this whole thing is literally cannot be explained by saying incompetence. You can't say these people just are bad at their jobs. Because if you're just bad at your job, accidentally some stuff would get done. Nothing gets done. No, there's no stone has been turned at all. Not no stone left unturned. No stone has been turned. Nothing has been done correctly at all. I'm still doing this PPE stuff, trying to get PPE to the hospitals and things like that. It's like pulling freaking teeth to get equipped to get this stuff. Trying to get equipment, trying to keep the hospitals supplied with what they need with the gloves and with the masks and gowns and things like that. It is unbelievable. These hospitals cannot function without this stuff. It's horrific. And we're a year into this freaking catastrophe, and you still can't get things done. There's nobody to call. There's no task force. There's no number in Washington. There's no central helpline. I mean, for God's sake, you freaking employ 50,000 people, and you have Jeff Bezos and freaking and Bill Gates oversee it, and you say, okay, coordinate here. You're going to have a fulfillment center for PPE product that gets distributed to the hospitals, okay? The United States government is going to buy all the freaking masks and all the freaking gloves they can get their hands on, and we are then going to use this Amazon, we're going to build Amazon-type warehouses and distribute the stuff. You know how we know that can be done? Because if I want a freaking candy bar, I can have it tomorrow by calling Amazon. If there's a will, there's a way. There's no will. There's no will at all to get this stuff done. Pisses me off. People are freaking dying. All right. Anyway, let's see if anyone has any questions. No, nobody has questions. That's fantastic. You guys, I must be fascinating. Brendan says, what's your view on this move, especially the Russell? Do you think this is sustainable? I don't know. I would tell you with enthusiasm it's not sustainable, but I can't do that anymore. It's just I'm beaten. I'm defeated. I don't see how you can sustain this. And I talked about that the other day. It was Monday. Let's see. I don't frankly know what I write when I'm on vacation. It's like autopilot. I vaguely remember writing something about this. Corporate profits. Bitcoin. Talked about Bitcoin there. Was it yesterday? It was yesterday. Huh. See, it seems like forever ago. Huh. All right, so you know, actually, really, you should read yesterday's post. I mean, that question was definitely answered yesterday. So, what's my view on this move? It's crazy. The Dow is trading at 30 times its value, its earnings, 30 times. And that's including Apple. If you take Apple out, it would be trading at 50 times earnings. I mean, I guess you'd have to take out Apple's value too, but you know, it'd be a lot. It's up 40% up. It's up 40%. PE ratio is up 40% from last year, and that's across the board. All the indexes are basically there. The NASDAQ is trading at 40 times earnings. And again, this includes Apple. Corporate profits, blah, 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 blah. So $3 trillion, so basically $3 trillion. You know, Apple's 200 billion, Apple's 60 billion. So it's like so like 2%. So Apple's like 2% of all profits. So Apple's like 2% of all profits in the S&P 500, or no, all corporate profits total. That includes small businesses and everything. So, you know, so for the NASDAQ, Apple is got to be a good 10 to 20% of the profits of the NASDAQ is Apple, and probably 10 to 20% of the Dow's profits are Apple. I mean, that's crazy. And I did that once. I remember we had some charts about like the S&P without Apple and the Dow without Apple, blah blah blah. We had some cool charts like that once. I'm not going to look for them again. But anyway, the point is 40 times earnings. What does it mean when something's 40 times earnings? It means it'll take 40 years for them to make back the money you're giving them. So earnings are like interest, right? Technically, because you're going to give a company money and they're going to pay you back, supposedly, right? How are they going to pay you back? Obviously, with interest, you get your principal back. You get your principal, you get your interest. Okay, they don't take your principal. So when you give a company money, they don't give you, they might give you a dividend, but if they don't give you a dividend, then the earnings are your interest, basically. They are going to be reinvested in the company, or something's going to be done with them, but hopefully they will add to and improve the value of the company. So your stock goes up, reflecting the money that's been earned over the course of time. So when you're getting 40 times earnings, it means it's going to take 40 years to make your money back, to get 100%. Therefore, you're getting roughly, in simple interest terms, you're getting roughly 2.5% per year. In compound interest terms, you're only getting about 1.2% per year. So who the hell would do that? It doesn't make sense. Now, bonds, of course, are paying nothing. Okay, 10-year note, 5-year note. Let me see the bond rates. Let's take a look at the actual numbers. Bond rates. Okay, a 10-year note 0.88%. 5-year note, 0.38%. Government, 30-year, 1.63%. Well, look, turns out that's a PE of 40. Basically, in between the 10 and the 30 is a PE of 40. That's why the money's going to the market. There's nowhere else to put it. You put your money in stocks or bonds. Either put your money in stocks or bonds. Or what? Keep it in the bank and get no interest? Buy a house that real estate's been crap for, real estate no longer has that shine that people want to put money into it. So the housing market is closed off to you. And the bond market doesn't pay anything better. And the stock market has been propped up to the point where people don't believe it can actually go down because the government doesn't let it go down. We haven't let it go down since really 2001. I mean, not in any, 2008 we crashed, but the government ran right in to save it, right? We don't let the market go down. They drop everything to save the stock market. And people now who are 30 years old, basically, 30-year-old kids have no idea that the market can just go down and stay down. It's never happened in their lifetime. We had the crash of 08. By 2010, it was over. That's the lesson they learned. If the market completely crashes, buy more. That's the lesson they learned when they were young. Now they're all the kids and all the young traders at Goldman Sachs and JP Morgan and blah, blah, blah. They're all the people who are playing on Robinhood right now. They don't believe a market can go lower. They don't believe it can happen. And that's who's trading. They got zero experience with a bear market. They don't understand a bear market. They think it's just a term that means we had a bad day. Nobody has seen a sustained bear market. Nobody has seen a sustained recession. Just hasn't happened. And we're not letting it happen. We're too afraid as a society. We're too afraid. And by the way, as these kids get older, when they become 40 in the next 10 years, and if we can keep this policy going like this, imagine how unlikely it would be they would allow it to happen. Imagine how once these people then become congressmen and senators and so on and so forth, and the 40 and 50-year-old people 20 years from now are going to be going their whole lives possibly without ever seeing a market go down. And they know that every time a market goes down, you put in more money, you put more stimulus, blah, blah, blah. That's how it works. The ignorance on that kind of scale would be just astounding. We could be we could be $100 trillion in debt. There'll be no semblance of reality to the debt levels that we could be at if we keep going like this. But doesn't matter unless somebody calls us out on it. What's the difference? As long as we pretend, and the ECB pretends, and the Bank of Japan pretends, and the Bank of China pretends, as long as everybody's willing to pretend that these loans are good and that it's fine to lend out money like this, and we're going to just keep lending each other more and more money at lower and lower rates and never demand the interest and never worry about it, we just print some more money. Everybody agrees, let's print some more money, let's print some more money. $14 trillion in stimulus this year. $14 trillion in the global economy. That's probably about 14% of the global economy. About 15% of the global economy is stimulus. But why stop? Is there any reason to stop? No. The only reason to stop, frankly, is because it can be weaponized. Because now, any country that wants to crash the markets and crash the whole game can do so by refusing to participate. In fact, Russia has been making noise about moving to a gold standard. And if a major country, Russia's not really a major country though, frankly, but if a major country like China or Japan decided to a major economic power. Anyway, Russia's just not an economic power. If you don't realize that, they're not. If a major economic power went to the gold standard, we could all be totally screwed. If they go to China, is don't forget making their own cryptocurrency. They could make that the standard, and if people start adapting it because it's a good currency, if people like the Chinese whatever cryptocurrency, obviously I wouldn't. It's kind of scary because they're, who knows what the state's going to do with the money or how they're going to track you. But if other countries start adapting it, and there are many countries in China's sphere of influence who could be forced to adopt the currency, then that could become the official coin. But if that becomes the official coin, and we're $100 trillion in debt, and China has an instrument that won't allow us to keep printing it ourselves, then we're dead. That's it. That's how fast they can force you into bankruptcy. So, the economic, and that's one of the reasons that they're starting to ratchet up this crap with China with the exchanges and stuff. They need to bring China to the table, because China, by putting up an alternate currency, an alternate digital currency, has the ability to make it a standard around the world. When they lend money in Africa, they can lend money in their currency. They can say, here's what you're going to use. And you know who's going to take that money? All the Chinese builders and all the Chinese banks and all the Chinese institutions. So they go to Africa and say, here you go. Here's I thought you know what it's called. What's the Chinese crypto? Chinese cryptocurrencies. China's making cryptocurrencies. See, transport subsidies. Well, okay, whatever they end up calling it. Here's the thing, though. They're doing this. This is subverting the international monetary system. State-sponsored cryptocurrency. The way they get it adapted, the whole key to having a successful currency like this, despite what BDC always argues with me, is to have it be transactable. How do you have it be transactable? Because China, we give aid around the world. China gives aid around the world to various countries. China, in their sphere of influence, gives loans and gives money to people in the cryptocurrency. They have to use it. And who accepts that money? Chinese businesses. In fact, China says, you will then use this money with Chinese businesses. You will not take money and use it with whoever you want. You can't take this money and have Halliburton come in and build your dams. We come in and build your dams. And we will track this money that we lent you, and we will know what you do with every dollar of it, because we're giving you the money. And it's our money, we track it. We know exactly where it goes. You can't go to the 7-Eleven and buy cigarettes without us knowing with this money. What a great way to put strings on something, right? But if they do this and build a widely accepted currency that's globally distributed, and they start to disrupt the euro and the yen, and they push it out, and they start pushing out, they can then basically start calling the shots on interest rates and banking rates and things like that. And if they don't play ball with us, and if they don't allow us to keep printing money anymore, then what's going to happen is their currency will become more and more and more valuable, and like a Bitcoin, right? Become more and more and more valuable. Our currency will become less valuable. You need more of it to buy their coins. And we will then become a subservient state to China economically. That's how easy it is. You don't need to fire a shot. You don't need to send in tanks. You don't need to go to war. We are tying the noose around our own necks and hoisting up the flagpole. And all they have to do is pull a string, and we're done. That's what the problem is when you go into debt like this. It's fine if everybody ignores the fact that you're this much in debt, right? If you have a credit card and you have a $50,000 limit on your credit card and you spend $50,000, they cut you off, right? That's when you have to stop. They cut you off and they say, start paying us back. But if you have a $50,000 limit on your credit card and you hit the $50,000 limit, like our debt ceiling, and the credit card company goes, here's another 10, here's another 20, here's another 30, here's another 50. As long as they keep doing that, you can just keep going out and spending. There's no consequences. But the minute they cut you off and say, where's the frickin' money you owe us? That's when it all comes collapsing down. Party over. So right now, we and Japan and Europe and even China, we're all printing money as much as we want and doing whatever we want. But at some point, if somebody calls an end to this game, as soon as somebody stops doing it, if they manage to deal with their own debt, they become incredibly strong compared to everybody else. And that's what the danger is, and that's why we're tussling with China about. It's not just about the stock market; it's about a lot of things. There's a lot of monetary issues with China right now, and this is one of the leverages we're trying to use is to say, oh, you won't have access to the U.S. capital markets anymore. You can't list on the NYSE anymore. Your companies won't be able to raise $100 billion, $200 billion to go public. And China's like, screw you. You know what we can do? We can go to London Stock Exchange. We can go to Tokyo. We can go to China. We don't need to list on the NYSE. It is very big. It's very powerful. But you know what? It won't be. We're shooting ourselves in the foot because it won't be if people can't list. It sure as shit won't be. You know what the message we're sending is now to China? To the world. The United States can arbitrarily delist your company. The United States can just decide we don't want to list you anymore on an exchange. How are you going to attract companies to list on your exchanges when they don't know whether or not when they know that some president, not even this president, doesn't matter if you like Joe Biden, but in 2024 Trump could be back, and if you piss him off or if he looks at you look at him sideways, he can delist your company. That's how America works. If the guy in charge doesn't like you, they take you right off the exchange and tell you you no longer have access to the market after you went through all the trouble, expense, time to get yourself listed and put yourself up there. Who would do that? You know, and again, it's one of those instances where it's like it's so incompetent and so poorly handled that you cannot believe they're not doing this on purpose. How do you accidentally do this? The repercussions of what they're doing right now with China Mobile and things like that are very long-term and very devastating to our financial ability to partake in the world. We are dropping out of our financial leadership position on the planet Earth, something we worked decades to build up to. We run the world financially at this moment, but what we're now signaling is don't trust us. Don't trust us to be your best capital market. Don't trust us to be the absolute place to list. Why do people list in America? Why do people like the American exchanges? Because we're a nation of laws. And those laws don't change. And those laws are only very slowly, if ever, changed by the Supreme Court of the United States and acts of Congress. And they're not arbitrary, and they're consistent, and they're fair, and they're clear, and they're reliable. We have thrown that book out the window. And that book of trust is an incredibly valuable American asset that we've just squandered. And it's going to come back and bite us. It really is. All right. Anyway, so that's all I got for the moment. Oh, wait. Mitchell says, meanwhile, Senate and House evacuated. Oh, no, really? Oh, shit. See, I wasn't paying any attention. The Senate and House have been evacuated. Pence is in a secure location. 6 p.m. curfew in the Capitol is under siege. What? God damn it. See, the TV wasn't working. I don't know anything. That's crazy. Is it affecting the market? Yeah, a little bit. Oh, I can't believe I didn't do that short. Damn it. Well, it wouldn't have mattered, but holy crap. Look at that. Wow. Wow. Yep. See, oil topped out at 51. We thought that was going to happen. And here comes gold back. Oh, such easy money, right? All right, guys. Well, it's more fun and excitement. Let's see what's happening. I mean, come on. Let's figure out what's happening in Bloomberg. Bloomberg Business Week. What's going on here? No, that's Bloomberg? Seriously? No. Ooh, that was a good article. Wow. These people on the crew of the cruise ships are killed. They're trapped on the cruise ships. They can't leave. Nobody's allowing them to leave the ships. They're stuck there. They've got nothing to do. You know, there's like no passengers. They're like living on these cruise ships, and they got nowhere to go and nothing to do, and it's horrible. And for some reason, they still make them stay in those horrible little cabins. They don't let them go upstairs and be in the nice cabins. Pro-Trump, oh God. How did this guy get to do that? How is this possible? Standing in the White House waving flags. Wow. Wow. Holy cow. It's like we're having a revolution, guys. Pence has rushed out. McConnell announces the effort to overturn the election. Wow. So what's actually happened? A group of protesters loyal to Mr. Trump breached the barricades at the Capitol and tried to storm the building. Oh my God. Holy crap. Pence rejects Trump's pressure to block the certification. Trump speaking to protesters says we will never concede. Oh, good. Trump's egging him on. Oh my God. Merrick Garland's going to be the Attorney General. That's interesting. Boy, you think Merrick Garland's got a list of people he wants to get? This dude is like standing in the White House. What the hell? What is he holding? What is wrong with this country? I don't know if you guys can see a video. Wow. It's really bad stuff. All right, well, I guess everybody should move to a secure location. I'm in Florida. I really have to move to a secure location. Holy crap. That is insane. Wow. Okay, I'm like freaked out now. All right, guys. I'm gonna take a break. I'm gonna go sit down and watch CNN for a bit and see what's going on. But this is a coup attempt. I think that's a very good summary. They are attempting an armed takeover of the Capitol. Wow. All right, guys. Good luck out there, right? Hopefully we'll be around to do this again next week. Good luck to everybody. Holy crap.